Welcome everyone, episode number 30 of the Wide Lens podcast. I've got Matt Rigby here and we're going to cover the latest.
Co-host, right? Remember that time when I was a co-host for that one episode? I'm back as co-host.
Did I say co-host or did
I think you said once.
Did I omit?
I almost put it on my LinkedIn profile.
Oh, you should.
Podcasting.
You should
co-host.
Update your LinkedIn profile. Co-host of the Wide Lens podcast.
There you go.
Yeah, excellent. Well, actually, you know what we should do? I should change the doc so it doesn't say colleague because I just read it's like a trigger thing.
Mate,
co-host.
like a robot.
And we're going to cover the latest topics in financial markets.
For anyone who has stuck with us for those 3 minutes of garbage.
Now, we're recording this on Friday, the 2nd of September. And yes, it is the 2nd of
4 months and we're done for the year.
4 months? What do you mean?
Crazy. I just can't believe we're in
September.
September.
Oh, yeah, 100%. We've hit spring.
What?
It's spring.
Yep.
All right.
Leaves are out.
Leaves are out. Sun's shining. The rain is still here. Footy finals this week. Pies.
Go the
Pies
team. Yep.
Let's get straight into Matt's Market Minute. We've got a lot of good stuff to cover today.
All right. I'll make it less than 10 minutes. Okay. So the Aussie market down just under 3% for the week that's to Thursday's close. Down about 10% year to date. A few companies that have reported. A2 Milk up about 16.5%, came out with good numbers. La Vista, the jewelry place, shop company, up 17%. Aussie Broadband down 15% after beating weaker guidance. But interestingly, 6 directors have submitted buy notices over the last couple of days. So maybe, insiders, maybe they know there's something going on. Min Resources down about 3 3/4. Bubs down about 1%. Harvey Norman off about 4. Webjet up around 8, saying all 8%. All 4 business segments made money in the fourth quarter, and things have started off really strong. So they're optimistic. Everyone's flying. I think they probably should be. NextDC. These companies met. NextDC down about 5.5. Fortescue down around 8.5. And Woodside down around 5. More on oil in a second. And the following companies missed. Adore Beauty down around just under 12%. And PointsBet missed. A lot of money being spent on advertising, which is not surprising. They're up against some big players, DraftKings and FanDuel in particular. They got deep pockets. PointsBet had that capital injection recently, but they just got approved for Kansas, which is a pretty big sports state right before the NFL season. So that, it's expensive to get a foothold. I think if you can survive a few years, then maybe it starts to pay off. Time will tell. Just one thing to maybe somewhat correct from last week. Ramsay Healthcare, I think I mentioned as we were kind of talking, or as I was talking, I noticed that KKR had made an offer. They'd already made an offer. It was a bit confusing. So what's happened is they've pulled the original cash offer and they've made a new offer, which I believe is only for part of the business. So there's a whole lot of uncertainty as to what's going on. KKR did a due diligence on the business. So I think maybe they found something they didn't like. Maybe, I don't know. Anyway, so there's a bid on the table. It's not the bid that it was. They've pulled that previous all-cash bid. All right, NASDAQ down 6.5 for the week, down 25.6 year to date. 58 of the NASDAQ 100 stocks are down more than 20%. Only 13 in positive territory. The S&P 500 down about 5.5% as well, 17% year to date. Down 7.8% from the recent high. That unraveled pretty quickly. 118 stocks positive for the year. 200.
And that'd only be from the last week or so, wouldn't it?
Yeah.
A week prior to
week
Jackson Hole. Yeah.
Yeah. Damn,
Oh, yeah.
Jay Powell.
Yeah.
So around 23% positive. 42% of the S&P 500 are now down more than 20%, which is up. That was 170 last week, 211 now. So it's been a bad week. From an earnings perspective, Okta beat. Now, this is all a bit weird. See if you can pick the trend here, Rob. Okta beat earnings down 40%. Lulu beat earnings down 9%. Baidu beat earnings down 4%. CrowdStrike beat earnings down 15%. Chewy beat earnings down 18%. Best Buy beat earnings down 8%. Hewlett Packard beat earnings down 15.5%.
The market's forward looking. It's not about the earnings they've just announced now. It's about future earnings.
Yeah. Five Below missed earnings up 1.5%. And Peloton missed earnings and rightfully down 6.6%. They're in a bit of trouble, I would gather. So if you own Peloton stock, then probably take a good look at the earnings announcement. During the week, Snap announced they're cutting 20% of their workforce. Bit of an indication of advertising slowing down there, and just I don't know how you monetize that platform. But they're up about 3.6 for the week. Nvidia down just under 22%, announcing that the US government have put additional export restrictions on their A1 chips. So they're the kind of more advanced chip circuits. So previously they couldn't sell to Russia. Now that's Russia and China. And they reckon that's going to cost them about 400 million in sales. Fair chunk of change.
From what I read, was in the US where they were talking about China using the chips for military use.
Yeah.
Is that
that's
the narrative?
The suspicion. Yeah.
Right.
I mean, these are chip boards, I guess, that you can, or chip circuits that you can use for military.
Yeah, it's for
hardware.
AI. My understanding is.
Yeah. So it's their A100 and H100 chips,
yeah.
I think. And any future chips that are more powerful or more advanced than these are also
banned.
captured.
Right. Yeah, right.
All right, so emerging markets, as gauged by VGE, down about 0.1 for the last 5 days, down 13% year to date. Oil down 6.5% year to date, up 16%. Sorry, let me start again. Down 6.5% for the week, up 16% year to date, trading at 87 US a barrel. Oil is now at the same price it was at the end of January this year.
Yeah, right.
It's a big move down, which is interesting. And Bitcoin up 2.7% over the last 5 days, down 57.8% year to date, $20,106 US a coin.
It just feels like everything's in a bit of a lull. Yeah. You know, there's a lot going on, but if you don't get so involved in the day to day, and you looked in January and you look today, it's like nothing's ever happened.
Yeah, for a few things. Although ask Peloton shareholders, they might disagree. But yeah, we're just in this. There's just so much uncertainty, and I think I've said it before. There's positive data and negative data, and we're just in this. Which way is it going to break?
What else you got?
And speaking of breaking things, Jay Powell spoke at Jackson Hole last week, which I think I mentioned. Had some pretty strong comments about interest rates and the direction that they're heading, and basically they're not letting up. The Dow dropped, the S&P dropped about 3%, NASDAQ was down about 4%.
But isn't that what the market isn't that what the market was expecting? Wasn't the market expecting the Fed to come out and continue to push this narrative to curb inflation? That's what they came out.
Yeah, I think the market was surprised by just how steadfast the Fed appear to be. Basically, I can't remember his exact words, but he was basically saying there will be no let up until inflation is absolutely under control. Whereas I think the market was hoping that we've had kind of a bit of flattening. Things look like they're possibly turning a little bit. Maybe they'll ease up. But I think a 75 basis point increase this month, next week after, and probably another one the following month. Like, I just don't think they're going to let foot off the gas until that bus is free falling over the cliff. Like, I think it's just recession's all but inevitable. It's just a matter of when would be the sense of kind of his comments. Who knows? But I was reading in Bloomberg during the week, they were talking about a growth recession, which is something I'd never heard of before.
Yeah, I have. Yeah.
So basically a growth recession it's not a soft landing, it's a protracted period of meager growth and rising unemployment, but not quite an all-out recession. So it's this...
Soft landing.
soft landing by another name, maybe. Yeah. So I don't know. But they seem pretty hell bent on continuing to raise rates and maybe not letting consumers' expectations get too far ahead of themselves and kind of not thinking that we're through the worst of it. We can go out and spend and do all this again. So
I think people were expecting probably some degree of like a pivot from the Fed, right?
Yeah,
and
I
then
think so.
I'm just wondering how much of what Powell's saying is just not only evidenced by the rate rises, but not giving the market any clues or giving anything away, even in their commentary and what's referred to as jawboning. Like,
yep.
Do you think that there's an aspect of that the Fed wants to maintain?
I think so, because it took them so long to, quote unquote, get some credibility back that they're just not willing to let it go at the moment. And I think you're right. Don't give the market an inch because it will take a mile. So just keep talking tough. Get 3 or 4 months of declining inflation numbers. Maybe see unemployment tick up a little bit.
Well, unemployment numbers are coming out tonight, our time tonight for the US.
Yep.
Which I also feel like every piece of economic data now is
scrutinized. The magnitude of importance is enormous.
Yeah.
Well, a great segue. So the Conference Board's August index of sentiment rose to a 3-month high. So that's consumer sentiment. Indications are appliances and cars are back on the menu. Job vacancies unexpectedly increased. So there is now 2 job openings for every job seeker out there. So
is that US or Australia?
Sorry, US, still US. And weekly unemployment claims at 232,000 versus 246 expected. So, the employment market is still very, very strong. In Australia, the AIG manufacturing PMI came in at 49.3, so that's contractionary, down from 52. It's going to be a bit of a theme here. Chinese manufacturing slipped into contractionary territory at 49.5. I think in Europe, current PMIs came in negative at 49.6, unemployment at 6.6. I was shocked that European unemployment is 6.6%. That seems really, really high given where we are globally elsewhere around the world.
Yeah. But we talked about Europe last week. Like, it seems as though they kind of operate. Well, I don't know what the drivers might be at this point in time, but it seems like they're operating on a very different sort of wavelength to everybody else.
Yeah, absolutely. They seem really out of step with the rest of the world. European inflation came in at 6.6%, I think it was. The market's now pricing in a 60% chance of a 75 basis point rise from the ECB next week when it meets. And UK inflation, I think we kind of flagged this, certainly not to this extent, but Goldman Sachs have come out and said UK inflation could hit 22% next year.
That's what I was referring to
natural
last
gas
week.
Prices
I thought it had hit.
remained elevated. No.
But it must have been the
expecting.
Yeah, wow, that's a big number. 22%.
I think Goldman Sachs is the second bank economic forecast to come out and suggest a 20+%.
Well, their track record's impeccable, so it's a sure thing, isn't it?
Lock it in, man. Lock it in. Interestingly, one last thing. I think South Korea's inflation for August was negative 0.1 for the month and 5.7.
Deflation.
5.7 for the year, down from 6.3 in July. I don't know. Make of that what you will. Maybe I'm grasping at straws, quite possibly. But yeah, inflation's high and interest rates are going up.
I made a comment last week about Biden when the last inflation number came out and he said it was 0.
Who said Biden did?
Biden.
Oh, yes, that's right. Yeah.
So I realised I didn't clarify that. So he was referring to the month-on-month change.
Yes.
Whereas no one really looks on the month. It's the year-on-year.
But it was month-on-month 0.
Month-on-month it was 0. So he's going out saying inflation's at 0.
I've conquered it. Look what I've done. Easy. Yeah, it was easy. All right. Give me a challenge.
Did you anything else on?
I think that's it, mate.
A couple of things that I just on some of your comments. On my birthday this year, 28th of September,
which is coming up.
28th of September coming up.
Whew. You're turning old. Is that right?
Yep. That is when. So you'll never forget this now. That is when the 50%.
You won't let me forget it. All right.
Fuel excise kicks back up. So the levy
Okay.
Great birthday
Well, it's
present.
interesting you say that because I noticed petrol was back down to $1.60. Like in the last 2 weeks, it's gone from $1.55 to $1.90 something down to $1.60.
Diesel's back up over $2. Second thing is, do you know why the Fed and others meet at Jackson Hole?
I don't know, because it's quiet and they get to go shooting.
Let me read this to you.
Foxes or something.
In the early 1980s, so the Kansas City Fed leaders, when they would want to get together, learnt that the best way to ensure that at the time the Fed chairman Paul Volcker would accept an invitation was to locate the event somewhere with good fly fishing in late August.
Oh, seriously?
And
Right.
Jackson Hole it was.
Why not make it work for you, right?
Well, how good's that, right? Like
That's
the
so
chair's
cool.
like, I can't be fucked coming to this thing. If there's fishing, I'm in.
Hey, Paul, we've got fly fishing. All right, done. I'll be there. Let me clear it with the wife. We're good.
So I thought that was a nice, fun fact. Do you want to jump into topic one?
Yeah, all right. So just a bit of property flavour. I was sent this by a regular listener. Thanks, Sandy. So he and I were chatting recently. He said, "Oh, I saw this report come out. I couldn't get full access to it, but there was something about someone had done some research on the property market in Australia. See what you can find out." So I managed to dig it up. It's Domain. So caveat right from the start: Domain make money by getting people to sell property and advertise on their website. So just so we're all clear. All right, so Domain has just conducted a comprehensive analysis of the major city property cycles. So it researched almost 3 decades of data, which is decent slab of data. Found that in previous property booms, house prices on average rose about 32.7%, and the upswing lasted around 33 months. So what's that? About 3 years, just under 3 years.
Yeah, called 3 years.
Yep.
10% a year.
So we'll say 10% a year, which I don't think that's rocket science. In previous downswings, house prices averaged about a 3% decline, and the falls on average lasted about 9 months.
So 3% per annum?
No, 3%
was the downswing.
across the 9 month on average.
Right.
Yeah.
But you have to annualize that number, don't you?
Oh, I don't know. So I'll call that 4% annualized.
Some other economists.
People do like to annualize stuff, like 1 month, 0.5%. So that's a 6 month annualized fall, right? So I think I was probably surprised at the low number that decline was, given the kind of increase. The volatility is relatively low on the downside compared to the upside, which surprised me. Anyway, so the pandemic boom lasted 21 months. Prices rose 33%. So during the
pandemic.
During the pandemic. So the price rise in percentage terms was about average. It just happened over a bit of a shorter period. So it's not all that unusual, which again, that kind of surprised me. I thought it was probably a bigger increase than what the averages were. So as for the declines, there have only been 4 periods where house prices across the combined capitals declined annually since 1990s, all stopping at less than 10%. So we've had 4 down periods since the 90s, all less than 10%. So again, pretty mild. And I think you've mentioned a few times, or like I remember hearing you saying, is even in the GFC it didn't fall 10%. So
I just brought some numbers while you're speaking, and the GFC is the downturn peak to trough was 2010, 2011, 1.5 years, was down 4.5%.
So that's
during the GFC.
About twice as long as the average downturn, being 9%, according to the 9 months.
It's 3% and 9 months. Yeah, that's right. And
so the decline was about average, during the GFC, it was a bit more than average.
And the duration was longer though.
And the duration was
twice the amount, but 50% more than the average decline.
Yeah.
3, 1.5, 4.5.
So it kind of fits with that. Okay. I did have a little smirk here, Dr. Nicola Powell. Sorry, Doc. But she stated in what I thought was just groundbreaking insight, the upswings have been longer than the downturns. which have been shorter and minor in comparison. Like, just the analysis.
Insightful.
So let me pull up this chart. So this is just showing the annual change in house prices for the combined capitals in Australia.
Okay, that's interesting.
Yeah, so there are the 4 negative periods. What's that? 2019. So that's the pandemic. Didn't quite get to 10%.
Annual change in house prices. Okay.
Yeah. So I mean, it's up and down. I don't think anyone's would be overly surprised by that. I think from trough to peak, it looks extraordinarily large.
Trough to peak, yep.
Yep, but it's over such a short period, such a compressed period of time.
You mean it bounces really quick?
Yeah, I mean, look how quickly it turns around when it does turn. And then that pandemic low to the recent high, which they comment there, was the average return, but just a much more compressed period of time. So it makes it look a little bit more dramatic.
What a jump, though. Have a look at the bottom right-hand side where we had 2019 where prices bottomed out. And then jump in 2020, we had a mild decline while people worked out what the hell was going on during the pandemic.
Yep.
And man, it just went on an absolute tear. So, like, why do you think people look at annual change and others look at monthly change? So annual change starts to smooth out a lot of the volatility. The monthly change, people then annualize the monthly change, which is absolutely ridiculous. But I mean, what do you look at monthly? Do you look at annual? Do you look at both the data points?
Annual. Monthly is it's mildly interesting, but
noisy.
Month on month can turn so quickly. I mean, as you point out there, that 2020, 21 slight decline, and then it just turns and rips. I mean, it's jumping around a lot. When it turns pretty sharp. It drops. It's up and down. It's still pretty noisy, I think, even looking at that chart. There's a whole lot of movement, but I think if you just kind of step back and go, ignore the month to month, look at an annual or a 2 or a 3 or a 4 year period. If 3 years is the typical cycle, then annually give you, I guess, a decent indication, but monthly, there's just so much going on. And I find and this is across the board, not just property, but those that are out there crowing the loudest, I often kind of step back and go, what's your angle? Like, why are you banging on about annualized 1 monthly house prices are falling? Like, what's your position? Like, how are you trying to profit off this? Like, where are you coming from? So I tend to try and ignore, like with the stock market, 6 months return, whatever. I'm looking at 10 years. I'm not looking at 1 month, 6 months.
Just on, you're talking about property prices. So the chief global strategist at BCA Research came out a week ago and said, as expensive as the US housing market is, housing markets in many smaller developed economies are even more overvalued. So they look at real house prices and they say New Zealand is the most expensive, Canada, Sweden, Australia, and then you got UK, US, Germany. And Japan's been the country with the house price that's always, it's not even, the real house price not even growing, right? It's negative. Price, and then they look at price to income. Again, New Zealand, Canada, Sweden, Australia, it's the same order. Prices to rent, New Zealand, Canada, Sweden, Australia. It's the same.
Picking up on a theme here.
It's the same order of countries.
Yep.
And this chart goes back to 2000, and you look back at the ranking of these countries. Every single country, almost in each of those different areas, if New Zealand was still the most expensive back in 2000, 2004, 2012, 2016, and it's the same ranking for that entire time. And so, let me just, where on earth did it go? I retweeted or shared his chart, and my comment was, the most expensive cities have always outperformed, and the cheapest cities have always underperformed. How did buying Japanese property in 2000 work out for you? So if you use that sort of analysis to help you make those decisions, it's always been wrong. It's always as if the most expensive, well, it's not if. That's what the history tells us, that the most expensive have
continue
always
to
been
be
the most expensive for the last 25 years.
Yeah.
In every metric that you look at. What do you think about that?
Well, I think that's really interesting, and there's probably a underlying reason for that, and economic conditions and incomes and interest rates and all that stuff. But I think I can only speak for Australia, but we value, for whatever reason, owning your own home is hugely important, and so it's a countrywide phenomenon, if you really want to call it that. But it's everyone wants to buy their own home. Like, we're not a rent society, we're a buy society, and therefore population growth, housing stock takes ages to build a house. So you got this natural supply demand, and clearly it plays out time and time again.
Unlike Europe, who is a lot more accustomed to
rent, and certainly parts of the US, for whatever reasons.
And do you think then there's just unmeasurable factors that contribute to valuations that can't be measured on a price to income, price to rent, and real house price growth? Real house prices should only grow by X and not Y. Like, is there this missing?
Absolutely. It's an intangible.
So why do we look at this stuff? Why does the head of research and the director of whatever? I'm sure they do, and they do excellent work. This is very insightful, but it's almost like you can't. The conclusions that you draw are not the conclusions that are drawn by the people who are doing the research, saying it's very expensive, don't buy these places. But those, if you listen to that advice and took the analysis and took that advice, you just would have been in a really bad situation.
Well, if the head of research can't research it, like, how do you research those intangibles? The dude's out of a job, or the lady, they're out of a job.
He's a dude.
Look, I think there is an enormous intangible, whatever it is, and I can't even think of the word, but I mean, you just want to, you grow up, you want to buy your house, you want it to be your own. There's a sense of financial security, rightly or wrongly, that we get our sense of pride, and this is our home, this is where we're raising our family. And there's that fear of, if I rent, I'm going to get kicked out, or I have to go and look somewhere else. That's a hassle. No one has to do that. And rent, is not that much cheaper. Like, if rent was 10% of the cost of a mortgage, then maybe a lot more people would be renting. But it's not that much cheaper.
No, well, especially as interest rates were super low.
And you don't get the asset at the end of it. So, there's intangible, but there's economic reasons to have it, and kind of intangible.
Let's continue with your charts.
All right, these charts, wonderful. So let's bring this next chart up. This is just the historic performance of house prices from trough to peak, price performance. So what kind of really jumped out at me here is 2020, 2022. If you listen to the pundits, the commentators, this surprised me that it wasn't so much stronger, so much higher than what we've seen in the past. I mean, 2000, 2004, that's absurd. Look at that.
That's interesting, isn't it?
Yeah, and look at 04, 08, that's about the same. 08, 10, that was better, although over a longer period of time in terms of return, it was better. 95 to 2000, price performance was better. So there's only been a couple of instances where it was less than what we went through 2020, 2022. So that kind of jumped out at me as that certainly wasn't what I was expecting. The next chart we'll bring up here is on the flip side, the declines. And obviously 2022, we don't know where this is going to end, but broadly
Chris Joy knows where it's going to end.
Yes. Hey, Chris, shoot us an email, info@baharian.com.au. I think that's our email address. And it's broadly in line with sort of what we've seen in the past. And this is over a quarter. So in the first quarter,
but if you annualise it, then...
if you annualise it, you're not too
off the
dissimilar
charts.
to where we were
It's off the charts.
2017, 19. It's broadly in line, right? Even that 10, 11, 17, 19, 20, so that it's not as... I guess the point is, this is all pretty normal, right? Where we are at this point. First quarter in 3 months.
So just on your chart before, 75% of the time in history, going back to the mid-90s, the change has been higher than what we've seen now.
Is that what you were just working at?
Yeah.
1, 2, 3. Yeah. So there you go. So, I think probably what I was going to say it's 2000, 2004. It's bang on in, what's that, 7 quarters? Like, it's exactly where it was at that point in time. Yeah, and that kicked on. Obviously, this one's taken a breather. But, yeah, I think probably the theme here is it struck me as just how normal and not as much of an outlier as I probably assumed it was. And then this last table I'll bring up here is just something that Domain threw in. It was somewhat interesting. So how far the current combined capital house price, which is 1.065 million, would need to fall to be at the pre-pandemic price. So essentially what they're saying is if prices fell by 5%, we'd be back to September 21, 10% June 21, 15% we'd be just back to where we were in March last year.
So if prices fell 15% from now?
From the high, the 1,065,000, which I think was the peak of the price.
Sure. Yep.
So a 15% price decline takes us back to where we were in March 2021.
Right.
20% December 2020. I mean, just 20% seems
1 year after the. Yeah. Okay. Yep.
Yeah. So, for all the doom and gloom commentators, like we say with the stock market, the stock market's fallen and it's now back to where it was. I don't know what it is now, 12, 18 months ago. It's not that bad. Like it could be a lot worse. So just a couple other things. CoreLogic came out with some stuff as well. Tim Lawless, just making some comments here. So despite the downwards trend, new listings through the colder months that we're hopefully behind, the total number of capital city homes advertised for sale held reasonably firm and are now at about 11.3% more than they were this time last year.
Yeah, but so, I don't know how you can compare from last year, like really.
I don't know. Well, because they do, because this is what you do, right? Rents are consistently rising. Affordability, so the gross dwelling yield bottomed out at 2.96%, so let's call it 3% in Feb this year. Yields are now at about 3.3%. So rents going up, prices coming down is helping that. This was probably the one fact that I actually found interesting. So mortgage costs and rents are rising. The household budgets are stretched, which I think we know. The proportion of annual household income required to service a new mortgage nationally increased to 44% in June, up from 40% in March. So 44% of household budgets are required to cover a new loan if you're buying a house today. Obviously, there's a whole bunch of factors, deposit, blah, 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 but this is just average across the country. I was surprised that it's that high and it's only up 4%.
Well, it's up 10%.
Well, 10% on the number, but 4% in real terms.
Okay.
I was expecting that to be a lot higher. I don't know what your thoughts are on that, but
did you see the Greens came out and they're proposing that there is a maximum increase on rental properties? So you can't increase your rent for a 2-year period by more than 5% per annum or something like that.
Man, it must be nice to live in bloody fairyland, right? Like, what the hell is that? So do you then cap council rate increases? Do you cap interest rates? Do you cap...
Well, you can cap your interest rate because you fix it in.
Well, you can fix it. But, I mean, it's the end product of a whole lot of other inputs that lead to that, right? What do you think about that?
I think it's ridiculous. I think it's ludicrous. Are we living in a communism society here?
Tell you what,
whereby you're dictating how much you can increase.
So you're determining how much you can earn on an investment.
Because you've got rates notices increasing significantly over the last 2 years.
Yeah.
You've got interest rates rising. You've got a variety of input costs to maintain and run that property.
Water servicing, like all this stuff.
And then you're limited by how much you can... surely that cannot even be a topic that gets discussed.
How did the media even pick up on it?
Maybe just the media pick up on that. So do you want to add anything else? I think you asked about the 44%. The thing that you use a 25% decline on the median house price and we'll get back to pre-pandemic levels. If you think about a 25% decline in prices, yes, it's not that big of a deal, but that breaches LVR covenants.
Yeah, that's right. I mean, could you? I mean, I don't imagine banks would be calling in loans because it'd just be bloody carnage.
No,
And
well,
politically,
you and I had a conversation with somebody yesterday
yes,
who I found that fascinating and really
Absolutely.
insightful. I don't believe banks will actively go out and revalue homes.
No.
And
I mean, it's not in their interest to, right?
It's in no one's
Can
interest.
you imagine the political fallout of that happening?
Forget the political fallout. Can you imagine what happens to the bank's balance sheet?
Oh, absolutely. Yes.
And hybrid securities that someone manages. So I just wanted to add a few comments. I saw you put this up on the doc, and I thought it was really interesting. There's a couple of things that I wanted to add here. This is from Shane Oliver from AMP. I'll just quote Shane, and I love Shane's work. His really balanced point of views. He shares great insight. The drivers of the falls are property prices, rising mortgage rates. We all know that, poor affordability, which is a consequence of mortgage rates. A rotation in spending from goods back to services, which I found interesting. Cost of living pressure, higher listings, and poor confidence. The property boom is well and truly over, as the surge in mortgage rates is pulling the rug out from under it. Australian dwelling prices fell another 1.6% on average in the month of August. And
Hang on, is that like 20% annualized?
18% annualized, which is on target to the 15 to 25% decline, spot on. So it's actually the largest monthly, or here we go. He says this, fastest monthly decline since the early 1980s recession, which I thought was really interesting. So it's a 1.6% on average in August, according to Core Logic. Their fourth monthly decline in a row, and the fastest monthly decline since the early 1980s recession. So I'll bring this chart up now. It's a capital city home prices, and you can see the monthly changes. And this goes back to 1990. And you can have a look on the far right-hand side. That's where we are now. Shane's put in there August 94, November 99, May 02, October 09, macroprudential tightening in 2015 and 17, if you recall. And look where we are on the far right-hand side.
Wow.
What's interesting to me is that you go back these 32, 33 years or so forth, and I'd probably say even early to the 1980s, every time things have gotten this bad, look what happens after that. Like it doesn't. Well, history says that these things don't go on for as long as people think they go on.
Yeah, because we extrapolate the recent past.
You
right?
you annualize a monthly number, and that's what happens.
Hey, just on that capital city home price chart. So I just read that the arrow shows the first rate hike in the cycle. Look at that one on the right. I mean, look how much prices had already come off before they started to raise rates.
Why were prices coming off? Yeah, but that look in 1994, that was the same thing. Look in November 1990.
But not to that degree. I mean, look where they were.
No, but they never rose to that degree. Look at October 09. That was almost nailed, that one. Prudential tightening. The first one in 15.
The prices
went up. No, I think what happened then is people were trying to get in and buy before.
Because I think it was forecast.
That's right.
Well, that's when the rate hike, right? So the arrow is the rate hike. That period, I guess, is the macro.
Yes, that's
but
true.
I think you're right. People were trying to get in ahead of it. Before
it's interesting. You raise a really good point that prices have fallen.
But I mean, you also look at. I said this before. I think we're getting. I almost think we're getting a bit more skittish in terms of the volatility. The size of an increase is happening in a much shorter period of time. Equally, the size of a decrease is happening in a shorter period of time. But look at the height. Look how far prices rose relative to those other periods. So naturally, you'd expect it's going to come down a bit further.
Is it because you're dealing with bigger numbers? Like you're dealing with bigger numbers, and
possibly.
Dollar changes represent a much bigger percentage potentially, or the other way around?
Potentially.
And do you think also? I mean, you and I have talked about this. Is that I think people are becoming smarter, and investors, and just the general public are becoming far more involved. I was going to say reading the papers and listening to the news. That could be a good thing or a bad thing, but trying to predict what the consequence of whatever is going on now and trying to get ahead of the curve.
Yeah, and I think that can be demonstrated by the number of people who fixed in home loan rates over the last year or so. Like,
yeah.
I think,
Yeah.
I don't know, this is just anecdotal, but I would imagine 15 years ago, 20 years ago, that volume of borrower would not have locked in fixed rates.
No, it's never.
I think we're a little bit more educated, people, the knowledge is disseminated across a whole lot of different mediums these days, and people are maybe taking a bit more notice.
So rates are going to continue to rise, and prices are probably going to continue to fall. My real estate agent called me the other day and said, "Hey, we took the property off the market."
Yeah.
They said, "Hey, let's catch up next week." So we're catching up with them.
Now's
next
a
week.
great time to sell. Is that what he's telling you?
I've got no idea.
Spring selling season.
He wants to catch up. So I'd be really curious to hear what the boys have got to say. Look, great guys. I don't feel pressured by these guys. Maybe because I have pumping up my own tires here. I feel like I've got a degree of confidence in my judgment calls because as me being part of the greater population, I'm smarter like everyone else is now. So I'd be really interested to see what he says. Springtime, I think this time the numbers are coming out and not as high as what I think people are expecting to be.
Yeah. And I think, I was chatting to a mate after basketball the other night, and he was saying he bid at an auction. He bought the place, but he said there were 4 active bidders, and he was surprised. He's like, we've been to so many auctions recently, and there's been no one bidding. And he goes, like, roll up, and of course, there's bloody 3 other people trying to bid. So I think that's really interesting. And again, that's just one example or one auction, but the auction activity over the next month or two will be fascinating to see.
I agree with you, and I reckon like your mate has probably picked up good value.
I think he has too. I think he's picked up a really good deal.
Instead of being so greedy about what the price is, like, I don't know what he's going to do. He's going to build his home and his family's going to move in or whatever the case may be. But over the next 10 years, you're not going to know whether that was, the bottom or the top or whatever. But people get too greedy. And I think the market will laugh in everyone's face and turn as quickly as it has in the past. And I'll just bring this second chart up that, again, is from Shane Oliver. And it shows real house prices indexed back to 1926. And it's the real house prices in red, and he's drawn a line which is a long-term trend. The past 100, and this is quote Shane Oliver, the past 100 years have seen a rising trend in real home prices, but there have been 3 major long-term booms in the late 1920s, the post-World War II period, and since the late 1990s. In between were weak periods in the 30s, 40s, and the 1970s. So if you look at that chart, you see a boom, you see a period of consolidation, boom again in the 40s. And the consolidation is just this period of volatility, but not much happens. And you and I talked about that at the beginning of this conversation, where you look at the beginning of the year, you look at the middle of the year, and if you didn't know what happened in between, it's like nothing ever happened.
Yeah.
And it could be very possible that we just go through this period of consolidation where not much happens. Property prices don't have to boom or bust. They can, it's possible, and they have done.
Trade sideways
just for nothing.
Yeah. Yep, absolutely. And, that gives time for incomes to catch up and, affordability improves.
Inflation adjusts.
Off we go again.
So I think just looking at things through a wider lens is really, really important, and not trying to get too caught up in extrapolating 2, 3, 4 months worth of data.
Yep, agreed.
Anything else you want to talk about on property? I reckon this podcast is going to be 2 topics: property and 5 or 10 minutes on my next topic, and we might wrap it up. But I think that was really good. I think we've covered a few bits and pieces there.
All right.
Are you good on the property front?
Yeah, mate. All good.
So I want to talk about screaming headlines, and since last week, and Jay Powell coming out, we talked about earlier on, and what the market has been doing during that time. So I just want to read some headlines to you. So Jeremy Grantham, founder of GMO, he came out he came out only recently.
A few days ago.
A few days ago. Here is the headline. Jeremy Grantham warns stock super bubble, quote unquote, has yet to burst. Let me share with you Jeremy Grantham's headlines over the past few years. So I jumped on Google. Okay. I changed the date search. 1 month ago, GMO's Grantham, S&P 500 could drop another 25% in the next year. January 2022. Jeremy Grantham says the end of the bubble extravaganza is coming, calling for stocks to drop 45%. November 2021. Jeremy Grantham says the next decline will be bigger and better than anything in US history. Here are 3 of his safe haven stock picks. The whole market's falling except for these 3 stocks.
What were they? Just out of
I
interest.
didn't even bother. I should have looked into it and pulled up a chart. July 2021, Jeremy Grantham, stocks, crypto are in bubbles worse than in 2000. 2014, market bubble will burst around the election. 2015, Jeremy Grantham says America's economy stinks and soon its stock market will too. And I'll finish off with a couple more. Jeremy Grantham, 2020, the market bubble will burst in the coming weeks or months. And in 2014 again, Grantham, quote, next bubble will be unlike any other. So this guy's clearly a perma bear. I think GMO's done really well. They're really well respected. Mm-hmm. But I just wonder, like, why so bearish?
Yeah. I don't know.
Who was that? Was that the Joker? Why so serious?
Yeah. Yeah, it was.
Jeremy Grantham, why so bearish?
That was Heath Ledger Joker, wasn't it?
Yeah, man, so good. Like, why so bearish, man?
Yeah, I don't know. It's interesting. Of all of those headlines, the market bubble will burst around the election. Well, no, it didn't. It took off. And, I think in every case it's probably wrong, except bubble extravaganza is coming. Calls for stocks to drop 45% January 2020. What did the NASDAQ fall? About 36.
36. So
I'll give him a B on that.
I don't think we need to spend too much time on it, but I just wanted to highlight that, once you start reading these headlines, just look back and have a look at how often these headlines have been coming out previously. Bespoke had some charts I just want to start going through now, and we'll wrap up on the stock market. You know how we were talking over the last week or two, I was becoming uber bullish about the stock market breaching its 50-day moving average,
yes.
100-day moving average.
So you're a technical trader a couple of weeks ago, right?
Yes, I'm expert, just for that day. And the market had breadth of like 90% of stocks.
Yes.
And what it failed to do was to breach its 200-day moving average, which is a pretty important number that technical traders look at. Mm-hmm. And so what I'll do now is I'll bring up this chart. Bespoke had this, which I found really interesting. This was the S&P 500 January 07 to July 2008. If you have a look at the blue line is the stock market, the orange line is the 50-day moving average, and then we've got the 200-day moving average. Have a look at back in June 2008. It obviously breached its 50-day moving average and failed to breach the 200-day moving average. We then went and we fell another 20% by the spring of, so this quote, Bespoke. As shown below, the S&P 500 hit an all-time high in October 2007 and then formed a downward trend that sent it down roughly another 20% by the spring of 2008. The first big bounce came in Q2 08, but the rally stalled right at the S&P 500's 200-day moving average and then broke below its 50-day moving average. From there, things continued lower until the spring lows were broken. If we're to compare the pattern of 2008 to the pattern of now, we're basically at the June 2008 point where the 50-day moving average broke. Have a look at the chart below that, and it's showing the April 2021 to present. And it's quite interesting, the parallels between 2008 and 2022. It's almost behaving very similar to that of 2008. Any comments on that or thoughts? I mean, that's just the data.
Yeah. It's funny.
No one cares what you think.
No, exactly right. Who gives a crap? Yeah, I mean, it is, and we've certainly talked about how it's feeling somewhat similar to the 2000 tech burst. Some stocks just been absolutely belted and probably will never come back, and companies will likely disappear, and others will be stronger and they'll come back, and off we'll go again.
So let's just extrapolate what happened in 2008, and I'll bring up in this chart in a moment, but I'll just read Bespoke. Extending the chart out to June 2009, you can see that the failure of the 200-day moving average and the break below the 50-day moving average in June was only the beginning of what would turn into a full-blown financial crisis. First of all, I don't think we're in a financial crisis at the moment. No. Right? I think we are worlds away and apart from what we saw in 2008.
Couldn't be further away.
So I'll bring this second chart up from Bespoke, and this is this is just a good summary. We saw that decline, and it took then from July 2008, less than 12 months for the market to bottom. In fact, it took 9 months after that. And what did the market fall? It fell another 45%, unfortunately.
Right? Jeremy Grantham.
I don't know if you got that one right. I didn't extend the date range that far back. And so we can start to see what happened in 2008. I personally don't think we're in a 2007, 2008 like era at this moment for a variety of reasons which we don't need to get into now. But I just a couple of comments I threw here is, could we be facing a GFC like event? My feeling is no. What do you think about that?
Yeah, I don't think so.
How different is the market today to back then? I think we just answered that. I think it's very different to what it was from 2007, 2008. Do you disagree with that?
No, I don't. I think it's funny. Look at that chart, and this is the thing I get with technical stuff. It does my head in. Okay, it hit the 200-day moving average, broke the 50, but that's not the reason it fell another 45% or whatever it fell. The reason is the world
blew up.
Financial world
Lehman
was
Brothers
just collapsing.
collapsed.
That's why it fell that far. So, we've hit it and we've fallen again. We may fall another 5-6%, and then we'll turn around and breach it again, and off we go again.
But that was such a out of left field event, right?
Absolutely. It's so far from where we are right now. I mean, the bank capital ratios are incredibly strong. Banks are a lot more aware of things, I would like to think. Probably speaking with regulators on a regular basis if they're feeling like things are not as good as potentially, or they're seeing risk. I think for commentators to say, the housing prices are falling and the banks are going to get whacked. Well, the banks are probably already thinking about that. They're already making moves to kind of factor that and accommodate that. And I think they're a lot more proactive than they're not just going to sit there and go, house prices falling. We've breached debt covenants. Oh well, what are we going to do? I mean, they're proactive, right? They're trying to get ahead of this stuff. So I think with the capital requirements that are in now, the banks are so strong.
Do you think that's globally, or do you think that's just in Australia?
No, I think it's globally. Yeah, I mean, the US banks, they've got their stress test every quarter, I think. The Fed do their quarterly stress test. And, the results recently were that the banks are generally pretty good. And if they're not, then they put a limit on, what they can do in terms of buying back stock and paying dividends. So there's a lot more of a proactive approach. And, Europe and all the rest of it as well. But US is one example.
Yeah, I was just going to mention something that's just totally gone, but I might just bring this final chart up, which is from Ritholtz Wealth Management. So I remember what I was going to say. I'll mention that in a second. But the reasons to sell, Jeremy Grantham, there's always a reason to sell,
Absolutely.
Right? So similar to that of your property chart of long term, this is the long term chart of the S&P 500 since its lows of March 2009. There's always been some reason to sell stocks. There will always be a reason to sell stocks.
Yep.
And this just shows that markets do go up, markets do go down. I don't spend too much time on this because it's not that profound or that insightful, although some people might think it is. And this is just a handful of headlines that we've seen over that period of time.
Yep.
What I was going to say was I was reading or listening to something, I can't remember exactly what. Back in the early 60s, I think it was Merrill Lynch or one of the banks wanted to put an ad out in the paper to say that you should invest in stocks because stocks perform better than bonds. And I think it was the SEC or whoever the regulator was at the time said, no, you can't do that because how can you prove that stocks outperform bonds? And so then the bank or whoever was issuing this marketing plan had to go back, and they spent, I think, weeks reconciling data to prove that was actual fact. I don't know if it was in the 60s, but I think it was. The point that I'm trying to make is that your comments around availability of data, people being more proactive, looking at trends and all of those things, think about now. I mean, we know that's a fact now.
Yep.
Because the information is available literally at our fingertips to do that.
Yep.
50, 60 years ago, people were just even wondering whether that was, you could even say something like that.
Yeah.
And so for that reason, I think that there's data available so much easier and quicker now that we're probably in a very different position than where we were.
Yeah, even where we were 10 years ago.
And just finally, this is from Sentiment Trader. Just to I might look like I've got egg on my face from my comments last week and a couple of weeks ago being bullish, but I think deep down inside I'm a bull, and I'm always looking at as a glass half full. Did you look at my book?
I was just about to grab it. Anyway,
for those who are watching or listening, there is a bull sitting in my office. Wherever I am in my office, I've always got that bull
charging,
and it's the Wall Street bull. But so what Sentiment Trader did was, I'll just quote Sentiment Trader. So they're talking about everything that's happened over the last couple of weeks. We talked about the 50-day breach, 100-day breach, and just didn't breach 200-day moving average. Now let's look at the price action of the S&P 500 itself, not the performance of the individual stocks. We, Sentiment Trader, looked at the S&P's price return in the 50 days following the June low, compared it to the 15 rebounds in the past from a low that had a correlation of more than 0.55 out of a scale of -1 to +1. The initial shot off the low tends to run out of steam around 50 days and the last through day 90. So I'm going to bring this chart up now, which shows in black the average of the highest correlation periods that have a correlation of more than 0.85, which is pretty high correlation, right? Mm-hmm. And so they went back to, I think, the 40s and had a look at when we've seen these technical breaches and how many days they lasted and so on and so forth. What were the highest correlation periods? They've got the average of that. And then they've plotted the June 2022 low to the present day. Mm-hmm. And you can see it basically follows the average of the highest correlation periods right up until day 40, 45-ish. And then it falls from day 50, and then nothing really happens, again, the sideways movement that we talked about, up until 90. But then they go on to show how hard these things rally after that. So in summary, they say the 50-day rally off the June low is comparable to other long-term bottoms. A price analog shows that the highest correlated 50-day patterns all showed one-year gains. Shorter-term returns were inconsistent, with several giving back most or all of the initial rally. But the highest correlated rallies tended to peak where we did now, but showed long-term gains. What do you think about that?
I think it's interesting. I mean, I think it's the bad news will pass. Whatever it is that's pushing stocks down will pass, and then fundamentals will be the focus, and companies keep making money, and conditions return to quote unquote normal.
So we got a few months of nothing.
Possibly. I mean, I think I mentioned the other couple of weeks ago that I think the inflation number may not improve for the next couple of months because of where we were this time last year, and it was a bit higher. But then after that, it could well be that inflation starts to drop. Investors get a lot more confident. Maybe the Fed takes the foot off the pedal. I mean, who knows? But that kind of lines up. 3 months from now, as to kind of where we're sitting, and potentially that's where the market starts to trade off. So 3 months from now would be 130. Takes out here. I mean, who knows? But I think long term, stocks go up. 10-year period, stocks go up. And I don't know, I just think it's as simple as that.
Unfortunately, I feel like it's just a process we need to go through. It's the medicine that we need to take, and there are no shortcuts in what we're going through at the moment.
And I think these periods just shake out the return chasers. The stock market, Bitcoin's the thing to be, stock market, property, whatever, let's get in there. It's not with a long-term focus, and they're jumping in and out and in and out, and that's what creates opportunities for long-term investors. Just when markets are down, just keep chipping away, keep putting money in super and let that grow, or whatever it happens to be. But I'm not surprised by that at all. What's probably more interesting is the consistency of that pattern for those periods. But they'll cherry picking those periods. It'd be interesting to see, what it would look like. How many periods they could find that have had such a sharp drop off, and what it does subsequent to that. Do you know what I mean?
Yeah.
So
although
we've kind of deviated here. What happened when periods fell like this? Did we keep falling?
Well, we'll wait for those analysis to come through from Sentiment Trader, and if they do one, we'll
Bring it up.
here. Let's wrap up and move on to directors' cuts. We'll cover a couple off there, and what do you got for us today?
What do I have? I saw this article from. It was in the Financial Review. It was the Future Fund. So Peter Costello's I think he's the chairman of the Future Fund. I think that's what he is. Anyway, so the headline was the Future Fund doesn't believe your super fund's returns, which was really, really interesting. Kind of caught my attention.
Say that again.
The Future Fund doesn't believe your super fund's returns.
Oh, okay.
So I was reading the article and kind of tapped into a long-held suspicion of the way particular superannuation funds value their assets. So I've often long believed that, some of the larger superannuation organisations are buying unlisted assets and basically cherry picking their valuations, essentially. And so Peter Costello made the point that super fund returns for the year end June 30 were based on valuations for private assets at the end of the March quarter. He goes on to say that during the June quarter, the Future Fund revalued their assets and writing the assets down by 5 to 10%. And I think they announced a negative 1.2% return for the financial year. But if they had the Future Fund. Mm-hmm. But if they had have used the private asset valuations as at the end of March, their financial year return would have been something like 4 or 5%. So he's just saying that is the degree of impact that revaluations can have on private assets. And there's been quite a bit of commentary lately about the Aussie tech company. Is it Canva? Mm-hmm. Yeah, and so a lot of so there's a whole bunch of companies that own this. T. Rowe Price.
Privately,
Franklin Templeton, they own it within some of their global growth funds, but a bunch of the industry funds do as well.
Here we go. Yeah, I can see it.
Yeah, so and he was just saying, so there's been a debate about how do we value these things, when do we revalue them, and not surprisingly, if you're incentivized by returns, you're less willing to revalue the asset as it's falling down. So some companies or some businesses are revaluing the asset by dropping it by 16%, 25%, but T. Rowe Price came out recently and reduced their valuation by 40%, which has caused a bit of a, hang on, if they're reducing by 40%, how is it that, I don't know, whoever the industry funds are on it, I can't remember off the top of my head, so I won't name them, but how is it that these industry funds are only revaluing by 25%? Or 15% or whatever it happens to be?
It's a bit of a fugazi, isn't it?
I mean, it's just such a murky area, and I totally understand why you would be looking in private markets, private equity, credit, and all the rest of it. There's absolutely a piece for that. Property developments, there's a good reason to have these assets in, but I just think the regulators need to get a lot more clearer on how and when you value these assets, because it's all just, it's not unlike some of the industry funds classifying property as a defensive asset. And their reasoning is it's a long duration. Well, if you buy Commonwealth Bank and expect to hold it for 40 years, isn't that a long duration asset? It's just there's just so much room for interpretation and manipulating asset returns. And now with, ASIC's return league table or whatever the hell it is that they call it, I think there's more incentive for some of this stuff to start going on. So anyway, it caught my attention. Kind of fed into some of my suspicions anyway.
It's interesting, T. Rowe Price devaluing Canva by 40%. A Future Fund holds Canva as well via Blackbird. So, quote AFR, the fund wrote down that investment by 30%. So everyone's kind of...
Picking their numbers,
that's the thing, right? Like, how do you... It's no... So what if... Let me put this to you. What if you got a listed security, hasn't traded for 3 months, end of March, it's got a valuation...
So and there's you got rules. I can't remember what it was.
I don't know what the rules are, but you got bid ask. And
something like if bid is higher than last, then you take last, and if last is less than this, you take, I can't remember what it is, but there's a formula. But I mean, for private assets, cynically, I'd say, well, they're all made up valuations until there's a transaction, right?
100%.
So what do you do? Get a consensus? Get an independent group to,
Maybe you
I
just
don't know.
Look, I think for the benefit of consistency, to have a level playing field, and whether they do this or not, I don't know, but I don't disagree. I think there should be some people. The everyday person won't understand the granularity of the things that we're talking about when it comes to valuations.
Sure.
So when you're at the bus stop or the tram stop or the train stop and you see these super funds saying they've been the best super fund performers of life, mate.
Well,
let's
look at asset allocation to start.
But that's
with.
what people see, man. You know what I mean?
Well, that's it. And what do they say? Something like past returns are no indication, but we're going to talk to you about our past returns. Like that. That's what they're selling themselves.
Yeah, and I think there needs to be some consistency. If you're going to report numbers, they have to be, as of 30 June, independently valued. There has to be, I think, that, and I don't know if that exists or not, and if it exists, clearly it's not working, but there needs to be something so that the everyday consumer has some level playing field to make some decisions. Even if you solve that problem, I think this is huge, because then you've got a discussion around asset allocation. How do you classify assets?
Well,
I can classify one asset as being defensive. Someone else classifies it as a
which is
risky
absurd,
asset.
right? It's absurd, because when you break it down, some of these industry funds and Host Plus, I'm going to pick on you. When you include property as a growth asset, which it is, then their balance fund isn't 70-30. It's like a 90% growth.
That's right.
So it's and then if you're comparing against the 70% growth, you've got this distorted advantage.
100%.
So
Look, let's wrap up with tips and recommendations, and I think we've gone a bit of a deep dive on a couple of topics. I might share first one.
Go for it, mate.
With you. So last week we went for brunch down on Brunswick Street in Fitzroy. I love going there. It's just funky and cool and hip, like me.
Just like you, man.
So if you haven't been to Electra, so they claim to be a Himalayan alchemy house.
What the hell?
Modern, eclectic, Himalayan-infused cafe located in Fitzroy, Melbourne. And man, it's just really cool. Like, good vibes there. The food's really nourishing. But their dirty chai latte...
Oh, here we go.
Mate, it was bloody good.
Yeah?
Yeah. It's probably one of the best that I've ever had.
Wow.
Yeah,
okay.
it was really good. They use loose leaf chai, so not a place for you to go. So Matt, avoid this place at all costs.
Where's your powder? Come on, people.
So if anyone is looking for a really funky, nourishing Himalayan alchemy house, head over to Electra, ELEKTRA, Brunswick Street, Fitzroy. Yeah, it's very different.
Cool.
So that's what I've got. What do you got for us today?
Mate, was watching a movie with my daughter during the week. No, last weekend, I think it was. Luck, which is out on Apple TV Plus, whatever the hell they call it. Look, it hasn't got particularly great ratings on IMDb, 6.3, Rotten Tomatoes, 49, and something else.
Who's John Hatzenberger?
I don't know any of these people. But man, it was just good. It was just a fun entertainment. So the concept is that there are people, there's a middle earth, a sphere that creates or manages good luck and bad luck.
Right.
And so you can get good luck and this string of good luck, or you can have bad luck. And the good luck people are trying to filter out all the bad luck, and they push that down below there. I don't know. Anyway, I have to watch it. Anyway, the concept of good luck and bad luck, I just love it because it's, people.
Do you have to do something to have like that good karma?
No, so the little leprechauns, they're the good luck dudes. So they run out, they come out into the earth world.
Is it just random?
Yeah, a little bit random.
Right.
Yeah, and I just kind of love that. Anyway, so it was just a really fun, entertaining film. Kids loved it.
Did they?
I thought it was fun. Anyway, easy viewing. Don't go in there with super high expectations, but it's just a good one to watch with younger kids, I think.
I'm just watching the preview. It actually looks really funny.
Man, the little leprechauns, they're cool as. And one of them is a cat.
Yeah.
He's awesome. It's just a fun film. But good luck and bad luck. It's
Apple
such an
TV, like
interesting
I don't.
concept, right?
You remember back in the day, you had to have like an Apple TV box. Do you have to have an Apple TV box, or can you just
stream it?
Okay, so you just sign up.
Sign up for free for
7
a month
days
or
for
whatever.
free. Sign up.
You'll even get to watch some baseball. I think they do now.
I don't
But
watch
anyway,
baseball.
but
This
Ted
looks
Lasso.
cool, man. I might
you
get the
could-
kids.
Have you ever watched Ted Lasso?
No.
Mate, that is
Ted
one
Lasso.
of the best.
On
Have
on
I'm
Apple
sure
TV.
I've reviewed it here. So good.
Is it on Apple TV?
Apple TV is quite possibly one of the best shows
It's a show.
I've ever seen.
Wow, that's
2
huge.
seasons in.
Although-
so good.
Okay.
So he's American NFL coach, coaches an English soccer team, Premier League,
Right.
but has very little to do with soccer.
Right.
It's set in that scene, but anyway, really good.
How am I going to watch this in my free 7 days?
Well, sign up.
No,
as
we're not-
you sign up as Dev. There's 2 weeks.
That's true.
There you go.
So
there you go. The bonus recommendation.
Super.
Ted Lasso. If you haven't watched it, man, awesome.
All right, let's wrap up for this week. Hit us
guys.
up on YouTube, Google,
Send us an
podcasts. Yeah,
Say hi.
There's so Spotify have got a new functionality that we might try start using where we can poll, we can ask questions, and we can answer them the following week. So
Kind of embarrassing if no one responds.
we might. The topic we'll never
just
bring the topic up. Thanks for listening, guys, and we'll catch you next week.
Cheers.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.